Hello students, the November 16 exam is going on and it will finish after 2-3 days, and then you will be facing the May 2017 exams, and there are some changes for May 2017 exams in the financial reporting papers, and we will be discussing those changes today. One of the main changes, property, plant and equipment, the new standard has come in replacing the accounting standard 10, and the accounting standard 6 has been withdrawn. So these are the somewhat the changes in the financial reporting. In the financial reporting papers for the May 2017, that is one of the major changes. This one, that's accounting standard 10, which was earlier named as a fixed assets, now it will be called a property, plant and equipment, and accounting standard 6 has been merged with the accounting standard 10, and therefore accounting standard 6 is no more in the book and your syllabus because it has been withdrawn. It has been merged with the property, plant and equipment standards. There are some other changes in the financial reporting papers, like because of changes in the property, plant and equipment, these fixed assets accounting standards, which now we are calling it property, plant and equipment. There are some consequential changes, like in accounting standard 2, that is of inventories, and they are very small changes. You may not be noticing it somewhere. There are a change in accounting standard 13 regarding the investment, and that there was an investment property there, and the little bit change is also there. And there are changes in accounting standard 29 and accounting standard 21. So these are some few changes, consequential changes in that case. And there are changes, there is a slight change in accounting standard 4 also, contingencies and event occurring after the balance sheet date. And that is as regards the proposed dividend. In the accounting standard 14, accounting standard 4, the contingency and event occurring after the balance sheet date, the proposed dividend was shown as a current liabilities under the head provisions. Now the proposed dividends, any proposed dividends will not be recognized in the balance sheet, or it will not be shown in the liability side. It will be disclosed through notes to financial statement. Dear student, if you recall, there was a revised schedule 6, and after that now the revised schedule 6 is now schedule 3 under the new Companies Act 2013. And in that schedule 3 it is written that the dividend which is proposed and which was declared after the finalization of the balance sheets will not be recognized as a liability in the balance sheet, and rather it will be disclosed as a notes to the financial statements. So that provisions and that thing was already incorporated in your schedule 3, but there was no change in accounting standard 4. Accounting standard 4, which was based on the earlier schedule 6, and which it was specifically incorporated in the accounting standard 4, that proposed dividend, even it is not adjusting events, will be shown as a liability in the balance sheet because to comply with that law at that time. But now the law has changed, law in the form of the schedule 3, that has changed. And now and in the schedule 3, if you see that the instructions are that if there are contradictory provisions, the schedule 3 says something, accounting standard says something. So it is the accounting standard which will prevail over the schedule 3. That is also instructions written in the schedule 3s. And therefore even the schedule 3 was saying that the proposed dividend will be disclosed and it will not be recognized as a liability. But still, because the accounting standard 4 was not amended, and the accounting standard 4 was saying that it will be shown as a liability, and therefore because accounting standard will override the accounting the schedule 3, because schedule 3 says so, and therefore still if you find, and you must be observing when you are doing your auditing and in the articleship, that proposed dividend is still appearing in the liability side of the balance sheets. Dear students, it will not appear now. After 1/4/2016, this will not appear in the liability side of the balance sheet. It will be disclosed as a notes to the financial statements. So that is the one of the change in the accounting standard 4. You must be aware it is not only for this. The another change is that, and which you may be facing in the May 2017 exam, is that if there is the Institute of Chartered Accountant has issued one guidance note regarding the derivatives, and that guidance note is also applicable for May 2017 exams, because it came into effect from 1/4/2016. Now that will also be applicable, because earlier there was a accounting standard 30, 31, 32, and they were withdrawn. Now, as far as the existing accounting standards are concerned, in the existing accounting standard, there are no treatment, or there is no accounting standard which describes the treatment of an accounting treatment of derivatives, and therefore the Institute of Chartered Accountant has issued the guidance note on derivatives, and that is applicable only to those companies who are not going for the NDS, because as you know that from the 1/4/2016 there are certain companies having net worth of 500 crore or more. They have now applied accounting NDS, Indian Accounting Standard, which are converged IFRS. And from the next year, some of other companies having a net worth of 250 crore or more will apply the NDS, and the company which are applying a NDS and following the NDS, this derivatives guidance note will not apply to them, because it will apply only to those companies which are dealing in the derivatives, but because they have no accounting standard, because we have now the 29 years up to 20 years 29, we have those accounting standards. Out of these, 2 has been deleted, accounting standard 8, accounting standard 6, depreciation has been deleted. Now effectively there are 27 accounting standards, and out of neither of these 27, no accounting standard deals with the derivatives, and therefore the guidance note on derivatives were there. But the company which are following the NDS, Indian Accounting Standard, they have got standards of financial instruments there, and therefore the derivatives are being accounted for as per the treatment given in Accounting Standard NDS 32, NDS 109 and NDS 107. So the derivatives are being dealt by the Indian Accounting Standards, which are converged IFRS, by those standards. But the company who are following this 29 accounting standard, existing accounting standards, are not having any accounting standard for derivatives, and therefore guidance note applies to them. So that is another change in that case. Dear students, as you know that I have written a book on the accounting standards, and this book incorporates the revised accounting standard 10, that is of property, plant and equipment, and this also includes the guidance note on derivatives, and the guidance note on derivatives has been added to the chapters of AS 11 relating to foreign exchange, and the accounting standard 10 is a separate standard there, property, plant and equipment. So these are some of the changes for the May 2017. You see, as far as the NDS are concerned, NDS you have got only the introductions, carve outs, carve-ins, and the differences with the existing one. That is what you have. There are no NDS in this in the syllabus, and only one chapter is there. This time you got questions of around 8 marks from that chapters. Generally the questions are of 4 to 6 marks, but this time there was a difference between the accounting standard 18 and NDS 24 related parties. So that was the difference which was asked this time from that chapters of NDS. Otherwise there are no other changes for May 2017, and now I will be dealing mainly with today and discuss this accounting standard 10. And the name was fixed assets. Fixed assets are nothing but the tangible assets. That is standard of dealing with the tangible assets. But after the issue of these NDS, the converged IFRS, there we are not calling them a fixed assets, and the name was given in the NDS. There is a NDS 16 there, which is the converged IFRS, and the government thought that there should not be much difference between the existing accounting standards and the Indian accounting standard NDS, and therefore they are now on the path of harmonizing these two. And now this accounting standard 10 is one of the steps towards that one. And this accounting standard 10 name property, plant and equipment, the name is exactly the same as it is in NDS 16, and the same is in IAS 16, the IFRS. Dear student, it's virtually the NDS 16, it's virtually IFRS. It has been replaced exactly by the IFRS. There is no difference between that. What the NDS we have issued, NDS 16 and this IAS 10. In fact, now when we will be discussing this IAS 10, and when you are reading and studying this IAS 10, you are reading nothing but you are studying nothing but the NDS 16 and its IFRS. So you will feel a little bit changes. Now there is some slight changes from the IAS 10. Maybe the terminologies are somewhat different, and it will take some time. You may be reading these chapters 2 or 3 times. After that, perhaps you will become conversant with the terminology used in these chapters. Otherwise, there is no any conceptual derivation change in that case. And if you read it carefully, maybe the terminology may be somewhat different, but the substance is the same one. The substance is same. And we will be discussing these whole chapters, and this chapters includes the depreciation. It also discusses the principles regarding the depreciation, which was earlier in Accounting Standard 6. Accounting Standard 6 therefore has been withdrawn, because the provisions regarding the depreciation has been incorporated in Accounting Standard 10 itself, that is of property, plant and equipment. So what I want to tell you, the broad categories is that in this chapter what we are going to discuss, we are going to discuss about the fixed assets, which are the tangible assets. The intangible assets are dealt by the Accounting Standard 26, and we will also be discussing the depreciation in these chapters. So both the chapters are now combined in this Accounting Standard 10, property, plant and equipment. Dear student, the name may be different, but as I told you, the substance is the same. Whatever we were calling earlier the fixed assets, we are calling it by name of property, plant and equipment. Maybe little bit of addition may be there. Little bit of additions may be there, but not very much. Maybe just 1 or 2% some additions are there, because that earlier IAS 10 may not be covering those points. Now, what is property, plant and equipment? What's the property, plant and equipment? And what is written in Accounting Standard 10 about what exactly is the property, plant and equipment? Earlier Accounting Standard 10 was talking about the fixed assets. Now it talks about property, plant and equipment. The substance of both is same. And if you see the definition and the description of this one prescribed in the Accounting Standard 10, it is almost the same. It says that PPE, we will be calling it PPE, property, plant and equipment, also generally known as fixed assets. These fixed assets are tangible property in contrast of the intangible property, which is dealt by another IAS 26. These tangible assets are, what I want to tell you, that it is the same. Name has been changed. We are calling it fixed assets, now we are calling it property, plant and equipment. And the definition of the fixed asset which was given earlier is the same here also. And what is that? What is the description? What is the characteristics of the property, plant and equipment? It says that held for use in production or supply of goods and services, for rental to others or for administrative purposes. And this type of the characteristics, the description was also in the accounting standard 10 earlier, unrevised. So you should not get disturbed that it is almost IFRS. The definition is almost the same. Held for use in productions, the fixed assets or the property, plant and equipments are the business is purchasing it for use, not for sale. What is purchased for sale? That is called inventories, and which is covered by the accounting standard 2. Here it is that it is held for, when you are purchasing certain property, plant and equipment, you are purchasing it for use, not for sale. But it doesn't mean that you can't sell it. After purchasing, if you find that you have purchased a wrong fixed assets, it is not suitable, you can very well change it. Or maybe after 2-3 years you find that now it has become obsolete, better type of upgraded versions of these fixed assets has come in the market, you may like to purchase it and like to sell the earlier one, you can sell it. But at the time of purchase, there is no intention to make resale of that assets. So that held for use in production or supply of goods and services, for rental or others, or for administrative purposes. What is the meaning of for administrative purposes? You see, if there is a company like Reliance, they have got a factory in the different places, but they have a corporate office in Mumbai, and that corporate office is meant for administrative purposes, and that building may be owned by the Reliance, so that is a fixed assets, property, plant and equipment for the Reliance, and that's a building. Now that building is used for, not for productions, not for supply of services, but for the administrative purposes. And that's why what the definition of the, it includes the held for use in productions, in supply of goods or services, or for rental to others, or for administrative purposes. So that's the characteristics of the property, plant and equipment. Expected to be used during more than one period. If it is expected for less than one period, then you can't capitalize it. When you want to show something in the balance sheet, means it's a balance. Something you have consumed, something is left balance at the end of the year, and it will be only when that you want to use it to another year. And that's why it says that this such type of property, plant and equipments are used for more than 1 year. If you are purchasing any asset which you are going to sell and consume within 1 year, then that is not the fixed asset and property, plant and equipment. So they are generally used or consumed for more than 1 year, and that's why that's the another characteristics of the property, plant and equipment. Not held for sale in the normal course of business. As I told you that when you are purchasing a property, plant and equipment, it is at the time of purchasing, the intention is not to make resale of that asset. Intention is to use it in production, to use in supply of goods or services, or maybe administrative purposes, but intention is not to make resale of that one. But it doesn't mean that you can't sell it. That's why it says that not held for sale in the normal course of business. In normal course of business, it is not held for sale, it is held for use. But there is no bar in selling it. As I told you that when you feel that this is not a now suitable assets, we want to sell it and replace it, you can sell it. For example, property, plant and equipment are, what are the examples of the property, plant and equipment? Example of property, plant and equipments are just like fixed assets. They are land, plant and machinery, furniture, fixtures, office equipments. These are all the fixed assets, and now we call them property, plant and equipment. Now these are the description of property, plant and equipment, and after that, listening these descriptions, you must be now realizing that there is no difference in between the earlier standard of fixed assets and this standard, which is revised one, and the name which is called is property, plant and equipment. What is the slight difference is that which will now go that what is the scope of this. When we talk about property, plant and equipments, the scope has little bit expanded, which was not earlier in the fixed assets. Now, this standard prescribes the accounting for PPE except when another ES permits different accounting standards. This standard, what is basically the scope of this standard? Why this standard? This standard prescribes the principles for accounting for the property, plant and equipment. Now, what is property, plant and equipment? The concept that I explained to you. We have described it. And in that concept, we didn't find any difference between the earlier fixed assets, now this property, plant and equipment. But now you will find a difference. When we talk about what it includes, and that this standard, therefore it says that what is the scope of this standard? This standard does not apply to which it does not apply? Biological assets related to agricultural activity other than the bearer plant. Dear student, what is the most important thing here is, in the earlier standards also, because this standard does never apply to the agriculture's activity and the any fixed assets created to that in the agriculture activity. Because in India, we haven't got any the accounting for the agricultures. And therefore, we excluded those assets from the agriculture, and there are any assets which are related to agricultural activity. But this standard, there is a one difference here, and which was not earlier in the fixed assets. It says that biological assets related to agricultural activity other than bearer plant, means only one, the bearer plant is a property, plant and equipment, which was not earlier in the fixed assets. Now, the bearer plant is a fixed assets. Bearer plant is property, plant and equipment. And when we say that bearer plant is a property, plant and equipment, then the principle of accounting prescribed under this standard AS10 will apply to the bearer plant. But you must be thinking, what is the bearer plant? You have a question in your mind. What's the bearer plant is? You never heard this this terminology earlier. You see, dear student, it's just the meaning is that bearer means this plant bears some things. So that is a bearer plant. Take a case of a mango tree. So mango in the mango tree bears the mangoes. Every year the mango comes up in the mango tree, but tree remains for more than one accounting year. Maybe it remains for 50 years, 25 years. Every year you will have a mango in that tree. So it is bearing that plant, that mango tree is a bearer plant. And the mango which comes every year, which you eat a mango from them, that mango is a fruit, and the plant is a mango tree. There may be so many other examples of it. All these fruits may be that when there is a sugar cane is there, but in the sugar cane you are cutting it, the sugar cane, crushing it and turning it to the sugars. So there is no plant there. So that there is no, the sugar cane has no bearer plant. But all these trees which every year gives you a fruit, there are bearer plant. So therefore it says that biological assets means these are all biological assets. Besides this, biological assets means which grows with a certain biological functions, and maybe that whatever the crop you have got, it's a biological assets. These are all biological things, that your wheat, rice, all these one. Now besides this, there are some other also. You see the living animals, like you have a cow, you have buffaloes, these are also the biological assets. And it does not include the biological assets related to agricultural activity other than the bearer plants. Only the bearer plants, it comes within the definition of accounting standard 10 property plant and equipment, and the accounting principles prescribed under this standards will apply to the bearer plant only. This standard applies to bearer plant but does not apply to the produce or of on bearer plant. As I told you that it applies to mango tree, but it does not apply to the mangoes which comes out of that tree. Every year the mango tree gives you a mangoes. So that mangoes is, this standard does not apply to mangoes, but it applies to mango tree, which is the bearer plant. Bearer plant is explained. I have already explained this bearer plant. What actually is this? It does not also apply to the wasting assets, including mineral rights. Expenditure on explorations, because you have got a different standards for it, different guidance note. So it does not apply. The principle which you are going to prescribe under this standard accounting standard 10 of property, plant and equipment will not apply to the mineral. You have got a wasting assets, including mineral rights. Wasting assets means which go unwasted. You purchase a certain land, and because you have got that there is a coal mine under that land, beneath that land there is a coal mine, and you took you purchased that land. You have not purchased that land for constructing the building there. You have not purchased that land for agriculture activity. You have purchased that land because you want to extract the coal from which is beneath under that land and then sell it, and after that you will abandon the land. Now such type of thing, that for you what is the asset? Asset is not the land. For you the asset is the coal which is beneath under that land, and that is also called wasting assets, or means it goes on wasted, because you when you extract the coal from the coal mine, then it goes on decreasing and it is being wasted to that extent. And therefore what we are talking about here, when we are talking about the property, plant and equipment, it does not apply to wasting assets, including mineral rights, expenditure on the explorations and the extraction of mineral oils, natural gas and non-generative resources. See, the earlier fixed assets were also not applying to this one. Therefore, now I think that if you summarize it, you will find only one difference in the scope, and difference is of bearer plant, and which was not earlier included within the fixed assets. Now it is a part of property, plant and equipment, and it means the accounting principles prescribed under the AS10 will apply to the bearer plant here. This standard applies to item of property, plant and equipment used to develop and maintain the assets for development of the coal. Suppose you have a right, you took a land on lease where there is a coal mine. The coal mine, that lease right is a wasting assets for you, because you will be extracting the coal from them. But to extract the coal, you have purchased a certain equipments, drilling machine and all these one. These drilling machines, it says that these are the property, plant and equipment, and that's why it says that in these activities, if you have purchased a certain equipment for using the biological assets, for wasting assets, for explorations of mineral oils, so all these machines will be part of the property, plant and equipment, and that will be AS10 will apply to them. Now I have explained to you that what is the biological asset. Biological assets also is a living animals, plant, and is a core income producing asset of agriculture activity, and these are all the agriculture's activities assets are excluded from here except the bearer plant. Now the question is that we have discussed what we have discussed. We have discussed what is the property, plant and equipment, what is the scope of this, and in that way I say that only thing what the new I find, and you must have observed that the bearer plant is another type of asset which has been included and which is because of this AS10 PPA. Now, we go to the recognitions criteria. In the earlier AS10 fixed assets, there was a recognitions criteria. In every accounting standard, there are recognitions criteria. Means how to recognize the asset, when to recognize the asset. What is recognition criteria? Recognition means you are now recognizing the existence of that asset in the books of accounts. You are writing that assets in the books of accounts. When to write it? What are the criteria for it? You have ordered for the plant and machinery on 1st January 2016. You make a payment on 30th June 2016 and you took a delivery on 4th April 2016. Now the question is that when should you write the books, that plant and machinery in the books? Whether on 1st of January when you ordered it, or when you make a payment on 30th of January 2016, or when you took a delivery on 4th of April 2016. You took a delivery, but 6 months it took to install that plant and machinery. There was a trial run in that plant and machinery, and then it was fit for productions, maybe somewhere in the November 2016. The question is that at what time you should recognize that plant and machinery in the books of accounts. When you should say to the rest of the world or in the financial books that it's my plant. So that's the recognitions criteria, and this recognition criteria is everywhere in every accounting standards. The accounting standard prescribes what are the, basically there are three things in the accounting standards. Recognitions criteria, when to recognize that asset, when to recognize that income. There is a measurement criteria, how to measure it, because ultimately if you want to write a plant and machinery in your books of accounts, at what value? And when the question of value comes, then you have to apply the measurement criteria given in that particular accounting standards. So this standard will also describe the measurement criteria, and then after that is a disclosures, presentation and disclosures. Where to present it, in the balance sheet or in the profit or loss, and if it in the balance sheet, where to put it, whether in the current, non-current, under which line items. These are the presentation, and what are the disclosure requirements, what we have to disclose in the financial statement about that asset. So these are the things which we are going to discuss in this property, plant and equipment. Dear student, if you see the recognitions criteria, you will realize that there are not much differences. In fact, you may not see any difference in the recognition criteria which were described in accounting standard 10 of fixed assets and now in the property, plant and equipment. Recognition criteria is the cost of an item of PPE, property, plant and equipment, should be recognized as an asset if and only if these two conditions has to be satisfied. For recognizing, for writing the plant and machinery or property, plant and equipment in your books of accounts. What are those conditions? Conditions are, it is probable that future economic benefit associated with the asset will flow to the entity and the cost of the item can be measured reliably. The wordings were different in accounting standard 10, fixed assets, but substance was the same. Here the wordings are little bit different, and dear student, you are not completely unknown to these wordings which you are describing now. What it says, it is probable. This word probable you will not find in the earlier accounting standard 10, but you will be finding it here. But this same type of conditions are in accounting standard 26, intangible assets, and these two conditions are also there, and same, there are no difference between these two. the recognition criteria, whether it's a tangible or it's an intangible assets, it is the same. I'd say that it is probable. There is no guarantee here. It's a probable that future economic benefit. Because why we call property, plant and equipment asset? We call only those things as an asset if you have got a future benefit for it. In the future, we will get a benefit. If you have a building, why you show it the building in the asset side? Because you will get a future benefit from that building. So, the asset, what is left in the balance sheet is a future benefit. The benefit which you have consumed goes in the profit and loss account. So, there is a what? It must give you, it does not say it must give you a future benefit. There is no must here. It says it's probable. It's probable. There is no certainty, but it's probable that future economic benefits associated with the asset will flow to the entity. The benefit must flow to the entity. Entity which has purchased the plant and machinery, what will be the benefit from that plant and machinery? It may be used for productions, and during the course of the productions, you generate the material or the product from there, and you will sell it in the market. And after selling in the market, the benefit will go to the company. But suppose the case is like this: you purchase the plant and machinery, you started a production, you produce the certain product, and when you sold in the market, the sale value goes to the another company. The benefit from the sale and the sale proceeds go to the another company. If it is the case, then the plant and machinery is not your asset. There is a future benefit in this plant and machinery. No doubt this future benefit is there. You are producing from it. The products are being produced. But the benefit of sale of that product does not flow to this entity. It flows to another entity, to another company. Then plant and machinery is not an asset of this company. Plant and machinery will be the asset of that company who will have a future benefit out of it. So, that is a first condition. Future benefits must be to the entity. The cost of the item can be measured reliably. That is another point. Because when you are going to recognize in the books of accounts the plant and machinery, you have to write in the books of accounts whether it is of 5 lakhs, 10 lakhs, 15 lakhs, 20 lakhs. What should you write? And you will be writing it at a cost. And suppose you say, sir, I don't know what is the cost of it. I can't calculate the cost. There is a benefit, the first condition satisfied. Suppose first condition satisfied. There is a future benefit from that asset. That benefit comes to the company. It's probable. But when you go to the second condition, they say, sir, I don't know what is the cost of this. And I can't calculate it. With a reasonable figure on which I can rely. No reliable figure can be calculated. Do you understand? If it is so, second condition not satisfied, then you can't recognize the plant and machinery in your books of accounts. You are using that plant and machinery, future benefit is coming to you, but if you are not able to measure the cost of that plant and machinery reliably, then you can't recognize it. Generally, this is extreme case. Generally, what happens in the business that you purchase the plant and machinery, you are paying the money, you purchase the plant and machinery for 50 lakhs, that 50 lakhs is the cost and it is measured reliably. So, in most of the cases, 99.9% cases, there is a cost because you are purchasing from the open market and the cost can be measured reliably. There is no issue in that case. Issue may be in a very exceptional item, and if it is issue, you can't measure it reliably, it will be not recognized in the books of accounts. The one thing has been little bit, you will find these are not very much expressly written in the earlier accounting standards. which is clearly written here, and earlier there was some discussion, confusion about the safety and environment equipments. The earlier accounting standard was not very much clear about it, whether if you purchase any environment equipments for the purpose of that there is no pollution in your factory, it is not polluting the environment, and then you install some plant and machinery for avoiding the pollutions. So no pollution is generated. It is not used for production. The definition which you are giving earlier, that it is held for use for production or rendering of services or for administrative purposes. Somebody may say that suppose in a chemical factory, there is a one plant and machinery you purchase which is producing a chemicals. Fine, that's the asset, that's a property, plant and equipment. But as per the government regulations, you have to install another plant because there is a release of the chemicals, bad chemicals from your factory, and the government has said that you have to get refined it, and for that purpose you are installing another plant and machinery for it, for refining that one. Only then that waste will go in the certain river. Now the question is that such type of environmental, it is only for the government compulsion, and because of the environment, because it is not used for production of chemicals, but because there is a certain waste is coming, and that waste has to be, it is injurious to environment, and therefore you have installed another equipment there or plant there just to clear that waste, and it is not injurious to the environment. It does not pollute the environment. Only for that purpose the plant has been installed. The question arises, whether such type of plant which was only for the purpose of not polluting the environment, they are not used in the productions of the product, whether they can be called property, plant and equipment. The earlier standard was not clear about it, but this standard now specifically says that all safety and environment equipment, environment equipment will be the part of the property, plant and equipment. And when we say that it will be a part of the property, plant and equipment, then means the accounting principle prescribed under accounting standard 10, property, plant and equipment will apply to it. So that was the little bit you will be finding what is the little bit difference between the earlier standard and this standard. Now we have discussed what do you mean by the property, plant and equipment. We have discussed what it includes and what it does not include. We have discussed that when to recognize and what are the conditions for recognition of property, plant and equipment in the books of account. Now the question arises, your property, plant and equipment, you purchase a plant and machinery, it satisfies the recognition criteria. The question is that at what value it should be written in the books of account. You purchase a plant and machinery which is having a fair market value of 50 lakhs, but you purchase it at 30 lakhs. Because the vendor, the seller of that plant and machinery was in need of money and he sold it for you 30 lakhs instead of 50 lakhs. The question is that at what value it should be recognized in the books of account. What will be the measurement criteria, whether we should write at 50 lakhs or whether we should write it at 30 lakhs. The standard says, and it is same as the earlier standard was saying, once an item of property, plant and equipment qualifies for recognitions, those two conditions, as an asset, it will be initially measured at cost. It will be initially measured at cost, means cost which you have incurred. You have incurred only 30 lakhs. So you will write it at 30 lakhs. Its fair value is 50 lakhs but you write it at 30 lakhs because the measurement criteria for the initial recognition, initial, I am not talking about the subsequent, we will be discussing that at a later stage. Initial recognition criteria is that will be measured at cost, and cost which you have incurred is only 30 lakhs. So, it will be measured at 30 lakhs. And dear student, the definition of the cost has changed. There is some clarity in that cost. There is no fundamental difference. What the earlier we were discussing what is the cost of the fixed assets in accounting standard 10 pre-revised and the revised one. But there is more clarity in these standards. This standard clarifies all of cost. I will not be discussing much on the general cost, which was also there in the earlier standards, which you have already done in your PCC level also. What is the new thing here? It says that what is the cost of the plant and machinery? It says purchase price including import duties, non-refundable purchase taxes, less trade discount rebates. It was earlier there also. No difference. Cost directly attributable to bringing the asset to the locations and conditions necessary for it to be used in a manner intended by the management. If you have purchased a plant and machinery, and that plant and machinery, what is the purpose and the objective of management? That it should be used for the production of the goods. So, it says that cost directly attributed to bringing the assets to the locations and conditions necessary for it to be used in the manner intended by the management. What is the intention of the management? Manner is that it will be used for the production of this particular goods. Means the expenditure till that point will be included in the cost of the plant and machinery. You purchase the plant and machinery, purchase cost will be included. You brought it, you purchased in Mumbai, brought it in Delhi, freight will be included. You got it installed, installation expenses will be included, because it is not ready for use, intended by the management. Management intention to take a productions from this plant and machinery. For that you have to do the installation. You did installation, you incur the expenditures, it will be added to the cost of the plant and machinery. Now, there is a trial run, because before producing the goods, you have to verify whether it is producing in the same manner and the product which is coming as per the standards, what we thought, what was intended by the management. For that they are doing a trial run, trial production. That is also a cost attributable and necessary to bring used in a manner intended by the management. So, that trial cost, trial run cost will be also be included. It was also earlier in the earlier standards also. Now, dear student, what is the difference? Difference is this: initial estimate of cost of dismantling, decommissioning, removing and site restoration at present value if the entity has an obligations that it incurs on acquisitions of the asset as a result of using it asset other than to produce inventories. AS 29 prescribes the discounting of such provisions, and provision is made at present value by applying pre-tax discount rate. Dear student, it says that initial estimate of cost of dismantling, decommissioning, removing and site restoration at present value. This will be the cost which will be added to the cost of the property, plant and equipment. Now, take example. Example is, you purchase a land on lease, but you took a lease, land on lease for 30 years. On that lease land, you constructed a building, factory building, and then put a plant with that and then started your productions. The factory building is constructed in the leasehold land and the lease period is 30 years. Lease period is 30 years. Then in that factory you purchase your plant and machinery, then you apply those plant and machinery were installed within that factory, then you started a production. You are selling your produce in the market. But the land on which a factory is there, where you have installed the plant and machinery, is on leasehold of 30 years period. After 30 years, you have to return that land to the owner. You have taken on lease for 30 years only. As soon as the 30 years will be over, you have to return that land in the same position that is written in the lease deed. In the same position, the site has to be restored in the same position as it was taken. Suppose there was a land, when you constructed your plant, your building, then the shape of that land was changed. You installed certain plant and machinery there. Again, you did so many construction with that. But the condition of the lease are that after 30 years, please return our land in the same position, at the same position as you have taken from us. Means you have to demolish, dismantle your factory, make it level as the same position, bring it to the same position as it was at the time of taking on the lease. Means if you have purchased, if you have taken a land of lease in 2000, then in 2030, you have to dismantle your factory, level that land, return it to the lesser in the same positions. And you feel that in 2000, you have total cost of land and building and the plant and machinery maybe 50 crores. And you know that after 30 years, you have to incur another 10 crores to restore the site at its original position. Means you have to dismantle, you have to demolish the building, factory building, you have to dismantle your plant, and the land has to be put and restored in the original shape. That will cost you 10 crores after 30 years. That you know, as soon as you started your factory building there, construction of factory building, installation of plant and machinery, at that time you know that after 30 years you have to spend 10 crores more on this factory building, plant and machinery. Maybe at present you have, your cost was 50 crores, and after 30 years you have to incur 10 more crores. The question arises, what will happen to that 10 crores? Is it a cost of that project, that cost of that factory? Whether the cost of the total factory and plant and machinery should be taken 50 crores or it should be 60 crores, because 10 crores will be added. That you know. What the accounting standard says, yes, you have to include it, this 10 crores in the cost of the asset. 10 crores to the cost of the asset. But whether it should be 10 crores or less than 10 crores, because 10 crores you are going to pay after 30 years. Therefore, it says what will be included in the cost is initial estimate of cost of dismantling. Initial estimate is 10 crores. Dismantling, decommissioning, removing and site restoration at what is important, at present value. What is the present value of 10 crores which has to be incurred by you after 30 years? What is the present value of this? So it should be included the present value. Dear student, you will be finding now the difference. We never talked about the present value in the earlier standards. We are talking at present value in these standards. And that's the effect of the IFRS. It says that if you have to make a payment after 30 years of 10 crores, please include the present value of that 10 crores. Present value may be 2 crores or 3 crores. So, the present value of the 10 crores which is to be paid after 30 years, today in 2000 it is only 3 crores. So, your total cost of the factory project will be 50 crores which you have already incurred on the plant and machinery, land and building, all these one, plus 3 crores, not 10 crores, 3 crores. It says that initial estimate at a present value, and that's the most important difference here. There is no such mention of cost in the earlier standards. So that is the, and you have to apply, to calculate the present value, you have to apply the certain discount rate. And what will be that discount rate? They have told you the discount rate will be the, what will be that? Pre-tax. It will be pre-tax, not after tax. And generally it is a interest factors. So the interest which is prevailing in the economy now is suppose 10%, the discounting factor will be 10%. So that is the most important difference which you will find in these standards. The measurement of cost. I have given the example of this in my book, how it will be computed and how it will be included in that one. And others are the same as in the earlier standards which you have already read in your PCC book. Now, these are the, we are talking about the cost of those assets which you have purchased. What will it will be included, how it will be computed. Now, we discuss what is the cost of self-constructed assets. Understand? It is the same as it we have got in the earlier standards. In the earlier standards, there was self-constructed assets and there was a certain principle in that one. Maybe that 60% was the same, but little bit difference now here. And what will be that difference is? It may not be same in some cases. And if you remember, in case of self-constructed assets or in case of exchange of assets, there was a principle laid down in earlier standards. Whereas there are no remarkable change, but in some cases, maybe in the exchange of assets, when you are purchasing one asset, giving the another asset, there is a change in that tools, in that principle. As regard the cost of self-constructed assets, you will not find a much difference in that one. The cost of self-constructed asset is determined, what the standard says is determined using the same principle as for an acquired assets. Same principle for acquired assets. If an entity makes a similar assets for sale in the normal course of business, the cost of the asset is usually the same as the cost of constructing an asset. Therefore, any internal profits are eliminated in arriving at such cost. Similarly, the cost of abnormal amounts is wasted material and they are not included. Cost of self-constructed asset includes the borrowing cost also as per accounting standard 16, borrowing cost, if it is a qualifying assets. So, the borrowing cost can be included. What is important here, and that was also in the earlier standards, no difference, that internal profit will be excluded. And what is that internal profit? Suppose you are constructing a building for your own, for your office purpose. You have not given the contract of this building to any contractor. You are constructing yourself, purchasing the material, supervising yourself, and constructing a building. You are a cement dealer, and because you are a cement dealer, you are dealing and trading in the cement. You have a number of the cement which you are using. You are not purchasing from the market. Cement which you are using for the construction of your own building is being used out of your godown, which you are generally selling. You are purchasing the cement, 50 kg cement, which is put in the bag, 600 rupees per bag, and you are selling it at 700. Now the question arises that when you are constructing your own building, you are using your cement from your own godown, which you have purchased for 600, but you are selling that cement bag to the outsiders at 700. The question arises whether if you have used 10 bags of cement which cost you 6,000 rupees, but their price is 7,000, sale value is 7,000, whether you should include in the cost of that building 6,000 or 7,000. And the standard clearly says that internal profits will be eliminated. You will not include it at 7,000 because in 7,000 there is a profit of 1,000. And therefore only the 6,000 will be included in your cost of your building. So internal profit will not be included as a cost. Now the exchange of assets. Here you will find a difference. In the exchange of asset, the earlier principle you need not to apply. Now you can forget about it. And as I told you that this standard is exactly the same as in IFRS or NDS 16. Therefore, there is a concept of fair value here. We talked about when the cost of initial estimated cost of dismantling, we calculated it at present value. We brought it at fair value of today. Here the same concept of fair value comes in the exchange of assets. AS10 specifies that exchange in terms of PPE, of items of PPE means property, plant and equipment, regardless of whether the assets are similar or measured. If you recall, in the earlier standard, there were principles which were based on whether the assets were similar or they are dissimilar. Here there is no question of similar and dissimilar. If the exchange of assets, whether it is of similar assets or dissimilar assets, that is not the principle here. That is not the basis of recognition or measurement. Basis of measurement does not affect whether it is similar assets you have exchanged or dissimilar. Whereas in the earlier AS10, it was there. It was affecting. And there was separate principle for similar exchange assets and dissimilar exchange of assets. Here it is only one. It says that it will be measured at fair value unless the exchange transaction lacks commercial substance. It will be measured at fair value unless exchange transactions lacks a commercial substance. It will be measured at fair value. Now fair value of what? Fair value of asset acquired. So fair value of asset acquired, you have purchased of plant and machinery, you gave them a one building. The fair value of plant and machinery was 2 crores because it is being sold in the market, and if you would have paid the money, it's a 2 crores. Instead that you exchange with your building. You gave him a building and took a plant and machinery. It will be acquired, it will be measured at fair value, which is 2 crores. You will not go in this one that this asset is not similar, dissimilar, what is the value or written down value of the building, like this, nothing else. fair value of the asset acquired. And if it is 2 crores, you will measure it at 2 crores. But the condition is that unless the exchange transaction lacks commercial substance. If the exchange transaction lacks commercial substance, then it not be a fair value. What does it mean? What is the meaning of exchange transaction lacks commercial substance? What is the commercial principle? You see, if you are giving a building and purchase a plant and machinery of 2 crores, so you must have commercially thought out. Because ultimately the future benefit, because both are assets, the future benefit from and the cash flow from both the assets may be the same. The building value must be 2 crores, that's why you are exchanging it for that. That's the commercially viable person will tell. Commercial sense said so. You can't exchange a building of 3 crores with the 2 crores of plant and machinery. And if you do it, because what is the meaning of 3 crores value of the building? Means the future benefit will be 3 crores. Future cash inflow will be 3 crores. If you purchase a plant and machinery which has a value of 2 crores, means future benefits, future cash inflow will be 2 crores. Can you exchange the 3 crores inflow with the 2 crores inflow? If you are exchanging it, you will never exchange it as a commercial decisions. When you are taking a decision on commercial basis, you will not do this. Because you will always see there must be a commercial substance in it. Cost benefit analysis. You can't purchase such type of plant and machinery in a business. You will say, why should I give you 3 crores for the 2 crores of plant and machinery? But sometimes it happens. It says that it will be measured at fair value. It will measure at fair value unless exchange transaction lacks commercial substance. Commercial substance will be there when the future cash inflows from both the assets matches equally. No businessman will do the losing business at the initial stage. Maybe at a later stage something bad happens, there is a loss. But at the initial itself, when he starts a business, he will say there will be loss. He can't start with that one. So it will be a commercially viable decision. But sometimes they may do so. If it is so, if you are exchanging a building of 3 crores with the plant and machinery of 2 crores, it lacks commercial substance. And if it lacks a commercial substance, then the valuations may be different. The measurement of initial recognitions will be different. So it is always at fair value if it has a commercial substance. It lacks a commercial substance, then it says, or the fair value of neither of the asset exchanges can be measured reliably. It says that regardless whether the assets are similar or measured at fair value, unless the exchange transaction lacks commercial, it is always valued at fair value, or the fair value of neither of the asset exchange can be measured reliably. Sometimes, okay, you exchange the assets of building with the plant and machinery. It was a typical plant and machinery, not being traded in the market. It has no such type of market. It is meant for the particular persons. So, and we say we give you a building, you give us a plant and machinery. We presume that it has a commercial substance. And therefore, we say that what is the fair value of this plant and machinery? It says 2 crores, fine. 2 crores. It will be measured at and written in the books of accounts at 2 crores. But suppose there is a commercial substance, but you don't know what is the value of this plant and machinery. You don't know what is the value of the building. You can't measure with the reliability, reasonable accuracy, the fair value of either of these two asset exchange. Then they say that you can value it at another way around other than the fair value. But otherwise, it is always at fair value. It is always at fair value. But if it lacks a commercial substance, then the principles are different. What are the principles? If the acquired item is not measured at fair value, its cost is measured at the carrying amount of the asset given up. It says that if it can't be measured at fair value, then the carrying amount will be of that asset, the asset which was acquired, in this case of plant and machinery, you can't measure the fair value of plant and machinery. You can't measure the fair value of your building. Then he says that you can measure the cost of that, initial cost of that plant and machinery will be the written down value of the building in your books of accounts. If the acquired item is not measured at fair value, its cost is measured at the carrying amount of the assets given up. You have given up the building. And what is the carrying amount of that building in your books of accounts? That is the written down value. And suppose that is 1 crore 80 lakhs. Yes, 1 crore 80 lakhs will be the initial cost of the plant and machinery which you have purchased in exchange of assets. So these are I have given a number of examples in my books. If you want, you can refer to that one. So that was the cases where we were talking about what is the cost of the assets and how it is measured. Now here the question arises. In the beginning, when you talk about the scope of that standards, we say that bearer plant is a PPE, is a property, plant and equipment. Now the question arises, how to measure the cost of the bearer plant? Bearer plant are accounted for in the same way as self-constructed assets, self-constructed items of property, plant and equipment before they are in the locations and conditions necessary to be capable of operating in the manner intended by the management. What it says that the cost of the bearer plant will be calculated in the same way as for the self-constructed assets. And in the self-constructed assets means what is the cost, direct cost, attributable cost to that assets. Internal profits will be eliminated and the cost will be calculated just like a self-constructed asset in case of a bearer plant. Before they are in the locations and conditions necessary to capable of operating in the manner intended by the management. So the cost of the bearer plant will be calculated just like a self-constructed assets. Dear student, what we have covered? We have covered what is PP, what it includes, the difference we found about the bearer plant in this scope. In the cost, what major difference you found? You found that initial estimate of the dismantling of the asset after some time. I gave you an example of the lease of 30 years and that was at the present value. And that was the concept of present value was brought in this standard first time. There may be some mismatching with other standard because at present we have no standards which is based on the fair value. This is the first standard when you are including the cost of dismantling at present value which is the fair value. When we talk about the self-constructed assets, we didn't find a difference with the earlier one which you have read in your PCC. But when you talk about the exchange of assets, in exchange of assets, the earlier standard AS10 you might have read in your PCC was classifying it as similar, dissimilar assets. There is no questions here. They said they will be recorded at fair value unless it lacks a commercial substance. It will always recorded at fair value of the asset acquired. So that's in summarize what is the initial cost. But dear students, suppose you purchase the plant and machinery on 1st April 2016. At that time, you have measured it at a cost of rupees, suppose 20 crores. Now on 31st March 2017, when your accounting year ends, you will present a financial statement to the user of the financial statements, to your shareholders, to the tax authority. The question here arises, the 20 crores of plant and machinery which you have recorded on 1st April 2016, at what value it will be shown in the balance sheet, whether it will be 20 crores or something else. Now, because in between, in December 2016, you incurred some other cost on this plant and machinery. Initially it was 20 crores, you incurred 2 crores more in December. But any subsequent cost, somebody may say, no, this 2 crores is on repairs and maintenance. It's a repairs maintenance cost. Because plant is running from last 9 months and it's a repairs and maintenance. Somebody may say, no, it's a 2 crores. It is not towards the repairs and maintenance. This cost should be capitalized. But dear student, we have to be very clear about whether the subsequent cost will be written off in the profit or loss, or it will be capitalized with the cost of the assets, cost of the PPA. The principle prescribed under this is almost the same as you have read in your PCC. It is the same one. What is that issue is whether subsequent expenditure is a capital expenditure or it will be written off in the profit or loss. Now, what are the principles in that and how to distinguish whether it's a repairs and maintenance which has to be written up in the profit or loss, or whether it's a capital expenditure which has to be put in the balance sheet. An entity does not recognize in the carrying amount of an item of PPE, means it will not be capitalized, the cost of the day-to-day servicing of the item. If it is a repairs and maintenance, it will not be recognized in the cost of the assets. Rather, these costs are recognized in the profit or loss. Repairs and maintenance costs are recognized in profit or loss. Cost of day-to-day servicing are primarily the cost of labor and consumables and may include the cost of small parts. The purpose of these expenditures is often described as for the repairs and maintenance of the item of property and plant and equipment. To qualify for capitalization, cost must be associated with the incremental benefit. That's most important thing. With the incremental benefit, you incur a cost of 2 crores, and if you say that no, by incurring this cost of 2 crores on this plant and machinery, you have an incremental benefit. Benefit to be derived from this plant and machinery has increased. Earlier you were deriving the benefit, you estimated the benefit 30 crores. Now by incurring the expenditure of these 2 crores more, the benefit has gone to 35 crores. So initial benefit from that plant and machinery has increased by incurring these expenditures. The standard says it qualifies for capitalization. It qualifies for capitalization means it will be included in the cost of the plant and machinery. Earlier it was 20 crores. Now it will be plus to 22 crores. Subsequent expenditure will be added in the cost of the assets. But suppose it says no, by incurring this 2 crores cost, there is no incremental benefit. Benefit of that plant and machinery remains the same. Then it's repairs and maintenance. It's a repairs to maintenance. So these are the somewhat the difference somewhere you will find in these standards. Now other things are almost the same as you have read in your PCC exams. Now we will go to, we have in the initial recognitions that will be recognized at cost. And what is the cost we have explained to you. What will happen to the subsequent cost which you have incurred? That we have done also. Now the question is that it was the initial recognitions. What about this? What about the measurement subsequent to initial recognitions? You recognize, you purchase a plant and machinery on 1st April 2016. You incurred an expenditure of 2 crores in December 2016 and you thought that it's a capital expenditure because there is an incremental benefit by incurring these 2 crores of expenditure. Then you said 22 crores is the cost. The question arises on 31st March 2017 whether you will be, what amount you will be showing in the balance sheet, whether 22 crores, less than 22 crores, more than 22 crores. So now this accounting standards set the principle for measurement subsequent to the initial recognitions, and that is on 31st March 2017. And this standard, there is a difference here. In earlier standard, there was only one, there were no accounting policies and there are no options there. Here you have options. It says that you can follow either the cost module or a revaluation model for it. On 31st March 2017, you can decide the accounting policies. The management can decide the accounting policy whether this plant and machinery to be carried at cost or to be carried at revalued amount, which is somewhat a fair value. So that is the decision which has to be taken on 31st March 2017. Earlier standard does not specify that. Earlier standard was saying yes, you have to carry it at cost, less depreciation, less impairment. You can't revalue it. There was they were talking about in AS10 revaluations, but there was no guidance about the revaluations. What should be this? When you should do? Why you should do? But in this standard, which is exactly as the NDS 16 or IS 16, it says that measurement subsequent to the initial recognition will be either you will follow the cost module or revaluation module. It is a matter of accounting policy. It's a matter of accounting policy. And management has to make a selection of that accounting policy. Whether they want to carry the asset, this plant and machinery in the balance sheet at cost, or they want to carry it at revalued amount. And this is a policy decision which the management has to take. If the cost module is followed, at what value it will be carried in the balance sheet? It will be carried at cost, less depreciation, maybe 10%. You provide on 22 crores, there is a depreciation of maybe it should be 2.2, but some cost has been incurred in the December. So maybe suppose it comes 2 crores. So 22 crores minus 2 crore depreciation. And suppose the impairment is 0. So impairment cost is nothing. Impairment, accumulated impairment is nothing. So it will be shown at 20 crores. Cost less accumulated depreciation, accumulated impairment. But what about the revaluation module? In the revaluation module, you will carry the asset at revalued amount. Suppose the management thinks on 31st March 2017, the revalued amount of this plant and machinery is not 22 crores, it's a cost. And the revalued amount is 30 crores. Then it will provide at 30 crores, depreciation on 30 crores. And it will test it for the impairment also. So in case of a revaluation module, what will be the principle of carrying in the balance sheet? That I said, carry at revalued amount being fair value at the date of revaluation less any subsequent accumulated depreciation. Subsequent, the word is subsequent accumulated depreciation, not the accumulated depreciation. Subsequent to the revaluations. Any depreciation which was earlier than that one means, suppose this 22 crore of plant and machinery you are revaluing you revalued 31, then you provided depreciation. After 2 years, you again revalued. So earlier depreciation gone. So accumulated depreciation will be subsequent one after that 2 years. Earlier accumulated depreciation will go. Any subsequent depreciation means accumulated depreciation means subsequent accumulated depreciation means after the revaluations, whatever depreciation you have accumulated. If you have done 2 times revaluations, because that as per this standard there are guidance on the revaluations. You have to do the revaluations periodically. Whenever there is a material increase in the fair value or decrease in the fair value of those assets, you have to revalue the assets continuously. It doesn't mean once you have done, then you need not to do it. No, it has to be, it's a continuous process. So that's the major change. What is the major change? Is about the carrying amount. At what value it should be carried? They will be carried in case of whether you are following the cost module, then cost less depreciation less impairment, accumulated depreciation, accumulated impairment. If you are chosen the revaluation module, then it says that revalued amount less accumulated impairment subsequent to the revaluations, and that will be the carrying amount in the balance sheet. So dear student, it's very important. Important is that there are 2 methods here, cost module, revaluation module, which was not earlier in the earlier standards, which you have read in your PCC. So there are 2 methods here and you have to follow them. It's a matter of accounting choice, and which accounting policy you should follow is a matter of account. You must have, you see, for that purpose you have accounting standard 1, how to choose accounting policy. You have accounting standard 5, which gives a guidance that how to choose accounting policies. So it's a matter of accounting policy which the management has to decide. It said that frequency, what will be the frequency of revaluation? Once you follow the revaluation module, revaluation must be made sufficiently regularly to ensure no material differences between the carrying amount and fair value. Whenever there is a material differences in the fair value, you have to again revalue it. It's a continuous process. It in that once you do, after that you will not do, that's not a revaluation model, which was there in the earlier standards also. There are a lot of guidance in that one. If you are revaluing the plant and machinery, you have to revalue the whole plant and machinery, that particular block of assets. If you are you have 10 buildings, if you are carrying the buildings at a revalued amount, revaluation model, then you have to revalue all the 10 buildings, not the buildings which have appreciated and buildings which have not appreciated in their value, you leave it. No, that you can't follow. So revaluation model, there are certain guidance provided in this one, and those guidance have to be followed when you are following the particular revaluation model. So dear students, this is the major change here in case of the revaluations, and you have a revaluation model here, and that is exactly the same as we have got NDS, Indian Accounting Standards, and the IFRS. They have given you treatment of increase or decrease in revaluation. The revaluation surplus goes directly to the equity. Means it will not be routed through the profit or loss, it will go directly to the equity in the revaluations model. If you have revalued the 22 crores of plant and machinery 30 crores, the 8 crores increase will go to the revaluation surplus, directly under the head reserves and surplus. And dear student, one point you must note here, that Institute of Chartered Accountant has withdrawn the guidance note on revaluation surplus, utilization of that revaluation surplus. It has been withdrawn in 2015, which was saying that because now you have to provide a depreciation on 30 crores because you have revalued the 22 crores of plant and machinery at 30 crores. Now the depreciation will be provided on 30 crores and there will be excess depreciation. Suppose you are providing a depreciation at 10%. So if it was 22, then 2.2. If it is 30 crore, then 3 crores. 80 lakhs more depreciation you will be providing. Earlier, what was that guidance note was saying that you can meet this excess depreciation from the revaluation surplus. Now that guidance note has been withdrawn. So you can't do it. You have to debit the whole profit, the whole amount of depreciation of 3 crores in the profit or loss statements. Utilizations or increase, decrease, how it should be dealt with, that is also very much clearly written, that when you sell it, when you revalue it, when you do it, then how this revaluation surplus will be done, that is also written here. So that is about the property, plant and equipment. In summarize, we have dealt in the case of the property, plant and equipment. What is this meaning of property, plant and equipment? Its scope, bearer plant, agriculture activity. You have a initial cost, dismantling cost at present value, exchange of assets at fair value. The concept of fair value has come in between. How to treat initial measurement, subsequent cost, and the subsequent measurement to the initial measurement. What will be the subsequent measurement? We have a cost model, we have a revaluations model. So, and there is a complete guidance, the detailed guidance about the revaluations. It's not just written that you can follow revaluation model. Complete guidance is given under this one. So that is how the property, plant and equipment is. This is the one portion of these standards. The another portion deals with the depreciations. And we will discuss these depreciations, that how it is the same way, how it is different than the earlier standards, which you have read in your PCC. As regards the depreciations, you have a schedule 2 of the New Companies Act 2013. You have also the guidance note on accounting for depreciations also. So that we will be discussing now. Dear student, as I told you that the accounting standard 6 has been withdrawn, and because the depreciations part, which was the accounting standard 6 was dealing, has been incorporated in accounting standard 10 itself. And I also explained you that what it includes and how it is related. I talked about the schedule 2 of the Companies Act 2013, which is related to this one, and how it is how this accounting standard 10 is related to that schedule 2 also, which I will be discussing now. But the question is that what is depreciation is? The concept of depreciation has not changed here, it is the same way, but perhaps you have to understood it in a different way. Till today we were most of the people and the students, what they think that the depreciation is decrease in the value of the assets. There is no decrease in the value of assets here, in spite of the fact that maybe there may be a value decrease, maybe utility may decrease, but the concept of depreciation does not goes with the value increase or decrease of the asset. The concept of depreciation is different. The depreciation, why we provide a depreciation? Depreciation is provided because you are using the asset. What is the definition of the asset? They are held for use. And when you are using the assets, you are getting a benefit from those assets. Then you have benefit you are putting in the profit and loss statement as an income. Suppose from the plant and machinery you are manufacturing the product is being sold in the market, you are putting in the profit and loss account in the income side the sale of the product. Now the question is that you have got a cost against it. And when you are using the plant and machinery, your asset, then that is also the cost for producing that particular product. And therefore the depreciation is nowhere related to the value of the assets. it is related for use of the assets. And what is the asset? Asset means that which has got a future benefit. You have a future benefit. Suppose when you purchase a plant and machinery in the first year of 2016, the future benefit from that plant and machinery was 20 crores. At the end of the 1 year, that future benefit has decreased, because 1 year you have used that plant and machinery. The future benefit may have decreased from 20 crores to only the 18 crores. Now you have consumed the sum of the future benefit, and if you have consumed that benefit, then certainly you have to put the consumption expenditures, whatever you have consumed, in the expenditure side, and therefore the depreciation is the consumptions of the benefit. What is the cost of consumption of that benefit, that has to be put in the expenditures. So dear student, you should not think that in case of depreciation, as the word meaning goes, that there is a decrease in the value of the asset. There is no decrease in the value of assets. The depreciation is a charge for consumption of the benefit. Depreciation is a charge for consumption of benefit of the assets. Now that has to be necessarily put, whether there is an increase, even there is an increase in the value of the assets, still the depreciation has to be provided, because you have consumed the future benefit of, you have consumed some of the benefit from that assets, and you have to put the cost of that consumption, and that's nothing but the depreciations. Now the question is that, how do you provide the depreciation? What are the factors on which it depends? What should be the methodology for providing the depreciations? Dear student, we have the schedule 2 under the Companies Act 2013, which talks about it. If you see the difference between the earlier schedule 14 of 1956 Act, which you might have gone in your PCC level, there the rate of depreciation were provided. Now if you see in the schedule 2 of this new Companies Act, no, the rate of depreciations are there. What are there? They just put a useful life of the assets, because the depreciation is for use of the assets, and therefore what is important, what is the useful life of that assets, how much you have used it, and then you will provide a depreciation. It has nothing to do with that, what is its value now, what was the value of the last year, nothing else. So you are consuming the benefits of the particular asset, and therefore the cost of that consumption has to be put in the expenditure side of the profit or loss. Depreciable amount should be allocated on a systematic basis over the useful life. What it said, that yes, you have purchased a certain plant and machinery for 20 crores on 2015, its life is 10 years. Now how that 20 crores benefits you are consuming over the 10 years, that's important, and that your depreciation has to be provided over the 10 years. Now that's why it says the depreciable amount should be allocated on a systematic basis over the useful life. The cost of that 20 crores has to be allocated over its useful life, which is 10 years, and that we call a depreciations. It has to be allocated over its useful life. So useful life is one, another is a depreciable amount. What is the depreciable amount? You have purchased the plant and machinery for 20 crores, actually that has to be written off as a cost, because at the time of the purchase you have not put that 20 crores in the profit or loss as an expenditures. This expenditure has to be put in the profit or loss over 10 years. How it should be put? Whether in the first year it should be 2 crores, it should be 4 crores, then next year 5 crores, next year 2 crores. What should be the pattern of putting that depreciation charge in the profit or loss statements? So it says that depreciable amount should be allocated on a systematic basis over the useful life. But the question arises, what is the depreciable amount? I say that you purchase a plant and machinery for 20 crores, and you say that no, after 10 years this 20 crores of plant and machinery can be sold in the market at 2 crores as a scrap. Then what is the depreciable amount? 20 minus 2, 18 crores. So you have to allocate 18 crores over its useful life, because 2 crores you are going to realize at the end of the useful life. So you must see what has to be allocated over the useful life. It's a depreciable amount, and then it has to be told that what is that depreciable amount is. What is the useful life? How do you determine the useful life? And that is all about this depreciation standards is. This portion of this accounting standard 10 talks about it. It said useful life and residual value must be reviewed at least each financial year, and if expectation differs from previous estimate, changes are to be accounted for as a change in accounting estimate in accordance with the AS5 net profit or loss for the period, prior period items, and change in accounting policy, adjusting depreciation charge for current and future periods. It said that useful life and residual value must be reviewed. As I told you that you purchase a plant and machinery for 20 crores. Your useful life you thought initially is the 10 years. The next year, when after using it for 1 year, then you thought that at the initial stage you purchase cost was 20 crores. You say that after 10 years you can sell it at 2 crores. Then depreciable amount you calculated 18 crores, and 18 crores you will be dividing over the 10 years. Now the question is that after using it for 1 year, you thought that no, the useful life is not 10 years, useful life is only 8 years. Now balance useful life has been now 7 years, 1 year you have used, now the 7 years are left. You thought that initially I thought that the residual value will be 2 crores after 10 years. Now the residual value will not be more than 1 crores. Now you have to re-estimate the residual value each and every year. You have to estimate the useful life of asset each and every year, because the depreciation will be based on the depreciable amount, and the depreciable amount, what is the useful life, what is the expected useful life, that is based on the estimate. What is the residual value, that is again based on the estimate, and the estimate will go on changing. It will go on change because you are predicting some future value, future life, and certainly you can't say anything by 100% that in the future it is going to happen. Life may change from 10 years to 8 years, 10 years to 12 years. The residual value can also, estimate of the residual value can change, and therefore this accounting standard provides that every year it has to be reviewed, and the effect due to this on the amount of depreciation will be difference of it will be treated as an estimate difference. It will be not treated as a change in accounting policy. It will not be treated as accounting errors also. It will be change in accounting estimates, and that's very clear here. Depreciation method should reflect the pattern in which the asset economic benefits are consumed. That's very important, and that's the principle of the depreciation. It says that depreciation method should reflect the pattern on which the asset economic benefits are consumed. Dear student, these are the wordings which you will be finding that, as I told you in the very beginning, that wordings may be different, terminology may be different, but the question is that it is no way different than what we have as standards earlier. Now, what it says that depreciation method, question is that you purchase a plant and machinery, cost was 20 crores, you estimated that residual value will be 2 crores, depreciable amount you estimated 18 crores. Now, 18 crores over 10 years, how it should be? Whether at every year 1.8 crores or first year 3 crore, then 2 crore, 1 crore, like this. Which method you should follow? It's not a matter of choice. What it says that depreciation method should be such which will reflect the pattern in which the asset economic benefits are consumed. As I told you that depreciation is a charge for consumption of the benefit, future benefit. Charge for consumption of the benefit. And if it is a charge against the charge for consumption of benefit, it should be charged in the same pattern as you are consuming the benefit. Take a case, you purchase a new plant and machinery worth rupees 20 crores, and you thought that in the future I will get a benefit of 30 crores from that plant and machinery. Certainly it will have a more than the cost you will get from that plant and machinery, the future benefit, and future benefit is estimated 30 crores. But how that 30 crores will be there? In the first year you will get a benefit of 5 crores because it's a new plant and machinery, there will be good productions, you will sell in the market, you will get a more benefit. So first year 5 crores out of 30 crores. Next year you thought that you will get a benefit of only 4 crores. Next year after that you thought that it will be 4.5. So it says that if you are getting a benefit of the pattern is like this, first year 4 crore, then 5 crore, then 4 crore, then 4.5 crore, then the depreciation should be provided in the same proportions. Because what is the depreciation charge? The pattern in which the consumption of benefit is done. Consumption is like this, 5, 4, 3, 5.4 like this. So in the same proportion you should provide a depreciation. Mind it, the accounting standard 6 does not specify any method of depreciation. And dear student, if you look the schedule 2 of the Companies Act 2013, that also don't define or don't give you any method of depreciations. It says that these are the useful life of the assets, and you have to write off the assets over its useful life. What method you follow? Not prescribed neither on the Companies Act nor in the accounting standards. Earlier you are having a rate in the schedule 14 based on the straight line method, based on the WDV methods, but there are no such type of rates for the WDV and straight line. It's only give a useful life of that one. Now now this accounting standard also don't say what are the methods of depreciations. It may give, for example, they say that for example it is a written down value method, straight line method, unit cost method, output method. They say these are generally used method of depreciations. But what is the basic principle is? Basic principle is that method, depreciation method, whatever you follow should reflect the pattern in which the asset economic benefits are consumed. It should reflect that pattern. If pattern is like this, that first you are in the first year you get more benefit and you are consuming the more benefit, next year less, like this. It means you should follow the diminishing rate methods, diminishing value methods of the depreciation. You say no, every year I get the same benefit. You should follow the straight line methods. And if you say that no, benefit depends upon the unit of products, how many units it has produced. So you should go by the unit methods. The question is that it does not say that which method you should follow. It says that it depends upon the pattern of benefits it has been consumed, the pattern in which the benefit has been consumed. That's a basic principle which has been laid down in Accounting Standard 6. If you recall, AS 26, the same lining are used in the AS 26 also as regards the amortizations of the intangible assets. Depreciation charge for each period should be recognized as an expense unless it is included in the carrying amount of another assets. Whatever depreciation you provide, that should be debited as an expenditure in the profit and loss statements. Maybe sometimes the depreciation may be capitalized. If you are constructing some assets and they are under construction, then maybe the depreciation may be capitalized. Otherwise, depreciation has to be written off in the profit and loss statement. AS 10 does not specify a method to be used. AS 10 requires that each part of, now this is the important here. AS 10, that's the radical difference, and this difference has been already been recognized in Schedule 2 of the Companies Act 2013. The Schedule 2 of the Companies Act 2013 also goes by component based of depreciations, and that's why you see that the guidance note issued by the Institute of Chartered Accountant on depreciation has been issued, and where there they have explained that how the component based of accounting based depreciation will be provided. But this is the somewhat a new thing in these standards. It says that AS 10 requires that each part of an item of PPE, that has a cost that is significant when compared to the total cost. The basic principle that each part of the PPE. But when you purchase a car, suppose the car has got an engine, car has got a total body, it has got a seats and all these, one tire. These are the component of the cars. The engine life is 10 years. The seats, tire and these all lives are 5 years. But and the belt life is different, the seat life is different, the body life is different. Should we divide the total cost of the car, which is suppose 10 lakhs, into so many parts and then provide a depreciation? What this accounting standard says? No. What it says, that what is the principle it provide, that depreciation method should reflect the pattern. Depreciation charge for each period should be recognized an expense, and it requires that each part of an item of PP, it has got, car has got engine, car has got a body, car has got a seat cover, car has got a tires. They have a different useful life. And therefore, you have to follow the component based. But should we do so many components? Should we provide a different amount on the tire, depreciation amount on the tire cost, depreciation amount on the seat belt, seat cost, depreciation amount on the body, depreciation amount on the engine? I think it will become more complicated. And therefore, what the principle says, that has a cost that is significant when compared to the total cost. Total cost of the car is 10 crores, 10 lakhs. Seat covers are 10,000s, 1% of the total cost. I think it's not significant. You say only you do the component, provide a different amount of depreciation on that component of the car which is significant. If you say no, it's not significant. 10,000, not significant. It has got a tire. Out of the 10 lakhs, 1 lakh is the value of tire. The tire it has got appears to be significant, 10% of the total cost. They have a life of only 5 years, whereas the engine has got a life of 10 years. Perhaps it requires a different components. You have to write off it in 5 years. The engine has to be written off in 10 years. Useful life is different. Second condition, that whether it's significant out of the total cost, yes, it appears significant, 10% of the total. And suppose it is 10,000 only, as we told about for the seat cover. So you say, okay, fine, we don't do it. We don't provide a separate depreciation for this component. This will be provided with 10 years. But the tire has got a life of which consists out of the 10 lakhs, 1 lakh is for the tires, and that is a 10% which is the material part. And therefore, in that case, it says that the cost that is significant when compared to the total cost of the item should be depreciated separately. Then the tire will be depreciated separately. Out of 10 lakhs, 9 lakhs, you divide by 10 for 10 years. For 1 lakh, you divide by 5 years. So amount of depreciation will be 9 lakhs divided by 10, 90,000. 1 lakh divided by 5, 20,000. Depreciation will be 1 lakh 10,000 first year. That's the way how the depreciation, component based depreciation has to be provided. So that is what this standard says. Dear student, you must, whenever we talk about the significant materiality, that's the fundamental concept in the accounting for applying the accounting principles. Because these accounting principles are to be applied by the business, the companies who are doing the business, and which always they run their business for profit, not for profit organization. These standards don't apply to charitable organizations, only to the profit making business organizations. And the business always, they do the cost benefit analysis. Until unless they don't do it, how they will earn the profit to survive? And we cannot make an accounting principle which are more complicated. The cost of implementing, applying that principle will be more than its benefit. Then no, that principle can't work here in the business organization. And therefore, we have to always bear in mind, and that's why this standard used that if it is significant, if that part, cost of that part of the total component out of the total cost is significant, only then you go for component based accounting or component based depreciation, otherwise not. It is small, you need not. There may be different parts of that assets having a different useful life, no doubt, but if they are significant, useful life, if their cost is significant, that's very important. Now, as I told you that what is the depreciable amount? Depreciable amount factors to be considered. Depreciable amount has to be divided over its useful life. How it should be? Depending upon the consumption of the future benefit. Now, what are the factors on which the depreciable amount depends? As I told you, it's the cost of that assets. What is the useful life? Expected useful life. What is the residual value? And that's the depreciable amount. As I told you, if the cost is 20 crores, useful life is 10 years, residual value is 2 crores, the 18 crores is the depreciable amount which has to be depreciated over 10 years. Now, the cost and these all things we have discussed about the PP, the earlier one. So, you need not bother about the what will be the cost, but residual value has to be estimated. And as I told you that this standard is very clear that residual value has to be reviewed every year. It has to be reviewed every year. Useful life has to be reviewed every year. And any difference on this account will be a difference of estimate. Not the difference, not the errors, not the accounting policy change. And therefore, say the depreciation methods, whichever you use, is also this standard is making the method of change in method also the change in accounting estimates. Earlier, if you go to the accounting standard 6, earlier one, you say that if you change the methods from WDV to written down or for any other vice versa, that will be considered as a change in accounting policy. But instead, here in this standard, he said that everything is estimated and there is a bound to be difference in the estimate. So, how could it be a policy change? It's an estimate change. And therefore, if you change the method of providing a depreciations also, it will be considered a change in accounting estimates, not a change in accounting policy. That's another difference, significant difference which you will found in these standards. So, change in value, the method of depreciation, again a change in accounting estimates. Because if you do the change in accounting estimate, the treatment is prospective. Change in accounting policy, the treatment is retrospective. So that we have to be very careful about it. We can't consider there as an error last year and therefore it will be considered as errors. No, it's not errors. It's an estimate which always change, may change, and therefore any methods you followed, because what they say, what is the depreciation method, how you should, they have not prescribed any method. They say the depreciation method should be such which will reflect the pattern of consumption of future benefits. So therefore, it has to be, and that consumption of future benefit, the pattern of future benefit consumption is again an estimate. So everything is estimate, so why should be considered a change in accounting policy? It says that if there is a land and building, land has to be separated separately, because if it is a freehold land, no depreciation because it has no useful life. For providing a depreciation, we must have a useful life of the asset. Land has no useful life, unlimited useful life, and therefore question arises, by what amount we should divide? If you have got a land has a cost of 5 crores, you say the useful life, how many years? Sir, I don't know. How we divide then this? By what amount? Because of this limitation, we don't provide a depreciation on land. But if it is a leasehold land, lease period is 30 years, 40 years, you have paid a certain amount for that one, certainly you have to provide a depreciation for it because it's a limited useful life. You can compute. So that's why the land has to be separately shown in the balance sheet and with not to the building. It has to be bifurcated. Depreciation method, the standard says that generally followed methods are straight line method, diminishing rate method, sum of units method. But it does not prescribe any methods. It does not say that you should follow these methods. The principle, it provides that depreciation method, whatever you follow, it should reflect the consumption of the future benefits. And that should be the any methods. If the consumption of future benefits pattern changes, then it will be different depreciation method. So how could you say that's a change in policy? Because it is on estimate changes. So everything is a change in estimate, not a change in accounting policy. You have to review the depreciation methods. Why you have to review? Because if it's a change in pattern of future benefit consumption, then you have to review it. Now, dear student, I talked about the schedule 2. In fact, India is following now the NDS. Those are the converged IFRS from 1/4/2016 for some companies having a net worth 500 crore or more. For other companies, 250 crores or more in the next year, 1/4/2017, and all listed companies have to follow. The banks, insurance, NBFC will follow these IFRS, NDS from 1/4/2018, and some of the NBFC will be 1/4/2019 having a net worth 250 crore or more. So we have a clear-cut map for implementation of this NDS IFRS. India, when we change the Companies Act, then we change the Companies Act according to that we keeping in view that we are going to implement the IFRS here. Because IFRS were totally based in case of a depreciation, they were based on the estimate, they were having a component based accounting, they were having the useful life has to be re-estimated every time and based on the useful life, not on the rate of depreciations. And therefore, we changed our schedule 2, which became effective from 1st April 2014. The IFRS was implemented from 1/4/2016, but schedule 13 was applicable, schedule 2 was applicable from 1/4/2014. So we started preparing for IFRS in between. When we revised our schedule 6, that was another preparations, because as per the IS1, which is now the NDS 1, we're talking about the presentation about the current, non-current and all these one that we did in revised schedule 6, now it is schedule 3. So we did the preparations for this implementations of these NDS. Now the depreciation schedule 2 of the company 2013, please go through the guidance note. The Institute of Chartered Accountants published on this one, and it talks about how the component based accounting has to be done. It has given example of the buildings there and what are the components of it, and that component based accounting is important. But this component based accounting should not be confused that every component has to be separately depreciated. No, it will be separately depreciated only when its cost is significant in relation to the total cost. If it is not significant, don't provide separately for that component. So here the example of the buildings were there. They say that building has got a structural design, they have got a lift, elevators, they have a heating system, they have a cooling system, they have an electrical system, and suppose there is a building and building cost is 100 crores. They said out of this 100 crore, 20 crores are spent only for the lifts because it's a high-rise building. You have a speed lift there, elevator there, 20 crores are only for that. It's a significant component. That lift, those lift or elevator which are there, they have only life of 10 years. Whereas the building structure has got the life of 50 years or 60 years. Certainly, the depreciation on the lift, which are the part of the total building, has to be provided separately. You have a cooling system, air conditioning of that building. Out of 100 crores, 20 crores are for lift, elevators, 30 crores is for the air conditioning system. That 30 crores has got the life of only 20 years. The structure has got the life of 60 years or 50 years. It has to be separately depreciated because useful life is different. Cost is significant. So these are the points which has been explained in the guidance note, and please go through that guidance note. That's important. That will give you a concept about explain the thing that how the depreciation has to be provided under the new and this accounting standard 10. There we talked about the PPE. Now the PPE, property, plant and equipment, are subject to impairment. That is accounting standard 28. Impairment has to be done for that, and that has been discussed in the accounting standard 28. Now when you make, there is a derecognition. We talk about the recognitions of the assets. Now it's a question of derecognition. When the property, plant and equipment has to be go out of the books. Recognition means when it has to be bring into the books. Derecognition means when it will go out of the books. That's the derecognition of the assets. And they say that when you sold it, you discard it, it becomes useless, then it has to go out of the books. And the principles are almost the same as it was earlier and not very complicated. Now there is a requirement for it, and the requirements are almost the same as it was there, but there are more requirements. Dear student, when we talk about the NDS and IFRS, because they have a lot of discretion given to the management as regards the fair value, as regards the presentation, recognition, measurements. Little bit more discretion to the management. There has to be check on that management, that discretion. Because the management may manipulate the financial statements. As a step forward, that's why the IFRS or the NDS gives a disclosure requirement, more disclosure requirement as our existing AS, as compared to the existing AS. There are more disclosure requirement. Why? It will put a check on the discretion of the management. If they have utilized they have chosen a certain discretion, certain course of action, they have to explain it. They have to disclose it with the financial statement. And if they disclose, and if they are doing something wrong, then there is a check. They will say, no, I have to disclose this, I am doing wrong. That can't be disclosed. Then they will follow the correct thing. So a lot of disclosure requirements. Because as I told you that it gives a more discretions. They are more discretionary, these IFRS. The IFRS basically presume that the management knows better. It's a management responsibility as in our existing AS. But we have got a certain hard and fast rule in the existing AS. We have not that much of discretion as in the NDS or in the IFRS, and therefore it has a more disclosures requirement. And the disclosure requirement are this one, but the only one thing which I will like to tell you that about because there is a requirement about the revaluations, and therefore how you revalue it, what types of, how do you do revaluations, how do you calculate the revalued figure, fair value. This has to be disclosed. Otherwise, people do any whatever they like for manipulation in the financial statements, so that the readers know that how they do the valuations. Now, this standard also requires that if the company follow the cost module, they please disclose the fair value of those assets. If they follow the revalued model, then they need not to disclose because that is already recognized in the financial statements. But if it follows the cost module, then they say what is the fair value of those assets, then they should disclose. They have a very detailed guidelines for the revaluations. Now in this standard there are certainly a transitional provisions. And what is transition provision? Because we will be shifting from one standard to another standards. Where an entity has in past recognized expenditure in the statement of profit loss which is eligible to be included as a part of the cost of the project for construction of property, plant and equipment in accordance with the AS10 revised, it may do so retrospectively for such period project. The effect of such retrospective application of this requirement should be recognized net of tax and revenue reserve. You say that, you see, you have shown us cost of the asset on 1/4/2017 2016, this standard is applicable. On 31st March 2016, cost of that asset is suppose 5 crores. And you know that there is a cost of around 50 lakhs which you earlier write off in the profit or loss, but as per this standard, it should be capitalized. Now I say that you can do it, but do it retrospectively. When this, in the year of it was done, you add it, provide a depreciation accordingly, compute it, and disclose it. It says that, but the effect of this you will put, where to put it? That says that directly in the reserves. Suppose due to that, that it increases the value of the plant and machinery, it increases the value of the depreciation, the effect of this should go to the revenue reserves, and reserves will be after tax. It should go after tax, not before tax amount. So that's what the transitional provision it says. The treatment of sandbag, it is the same as the what you have got in the PCC, but there is extent as the new taxation system, indirect tax system is coming, GST, with effect from 1/4/2017, that the whole thing, this standard will also change. This guidance on the sandbag credit, this is based on the guidance given by the Institute of Chartered Accountants, and this will change from 1/4/2017 because the goods and service tax will be implemented as the government says. So this you have to look it, but for the May 2017 it remains for May 2017. You have the summary of this one that you can see. These are the summaries of this. I have included 1 or 2 illustrations in it. You please go through that one, and after that, doing these 2 questions, perhaps you will understand how it will be applied. For more applications, you can follow my book, is there, where a lot of questions are given, and you can follow that for your practice, so that you can know how these principles are applied in the practice. So that's for that purpose you have to do the more illustrations, more questions on it. So therefore, dear students, that is all about the Accounting Standard 10. This Accounting Standard 10, as I told in the very beginning, is based on the NDS 16, which is again converged with the IAS 16. The name is also the same, property, plant and equipment. The provisions are also the same, and there are no differences, much differences in fact in between these 3 standards. We are on the verge of harmonizing these standards, and therefore the ICAI wants that there should not be much difference between the existing accounting standard and the NDS, and on that path they are again revising other standards also. But for you, for the May 2017 exams, these standard as it is, except this is change which I explained today, that is different, otherwise other standards remain the same. So small changes due to this standard and the AS4, which will be also changed. These all changes I have incorporated in my books also, and you can also go through these standards, and that will appear in May 2017 exams. After that, if the new syllabus comes, perhaps you are not sure what will happen after May 2017, but for May 2017 these are the standards, and you should not at all confuse yourself about that how many Indian accounting standards are there. You need not to go through the Indian accounting standards. What you have to go one chapter of the Indian accounting standard. What are the Indian accounting standard? What are the carve outs? What are the carve in? And significant differences with the existing standard. If you can do fine. If you can't do, is it okay? Because it will be difficult to cover all those differences. So you can also take your strategy decision from the examination point of view. Otherwise, they are in syllabus. So in the financial reporting, please, for this May 2017 exams, you rest are the same, and you must have seen the paper of the November 2016, where there are little bit changes on that papers. The more emphasis on the accounting standards. You have a lot of questions on that accounting standards. First and last questions totally on accounting standards. In between there are for the NDS question 8 marks, and there are some questions which are based on the financial instruments. There were questions this time also about that the guidance note on the guidance note on derivatives. There is a questions of 4 marks questions on the guidance notes. So therefore, this time what you have to do, that you have to be little bit be concentrate on accounting standard 10, some guidance notes, and these, if you go through it this time, you will not find a much differences with the more about the valuations of the goodwill and shares not, because the proposed syllabus which will come after when this new scheme will be implemented, there are no date has been notified for the new scheme of the by the Board of Studies. At present there is a hold, you need not to worry about the new scheme, but in the new scheme the financial reporting paper only consists of Indian Accounting Standard NDS and nothing else, and but those NDS are 41 NDS are there, so the large volume is there in the one, and therefore I hope and I pray to the God and I have a blessing that you pass as soon as possible in the final, because then otherwise you have to face the new syllabus. Maybe that they may be giving 1 or more 2 opportunities for these one, but not much, because you should, if you are appearing for May 2017, pass as quickly as one. So be concentrate on your study more, and so that you need not to face the new syllabus. When the new syllabus will come, it is expected from next year, but no, please don't confuse yourself at present. It is May 2017, the syllabus is like this, and need not worry about the new syllabus at all. And this is the syllabus on which you have to concentrate. Thank you very much.